A lot of people think buying a home automatically means they're building wealth. But what many homeowners don't realize is that the bank can end up making almost as much money as they did on the property itself. For example, on a $550,000 mortgage, you could end up paying nearly $400,000 in interest alone. That's money that could have gone towards investing, traveling, retiring early, or even buying another property. And the scary part, most people simply accept this as normal. But in today's video, I'm going to show you 8 strategies that could potentially save you 6 figures in mortgage interest and help you become mortgage-free years earlier. Imagine what your life would be like if your mortgage disappeared 10 years early. What would you do with an extra $1,000, $2,000, or even more every single month? I'm Gabrielle, a chartered professional accountant, and I'm also on my own journey towards financial independence. Along the way, I want to share what I've learned so that we could work towards financial freedom together. And one of the biggest milestones in becoming financially free is owning your home outright. Because once your mortgage is gone, your monthly expenses can drop dramatically. So in today's video, I'll show you how mortgage interest actually works, how much you may really be paying the bank, and 8 strategies to help you pay off your mortgage much faster. But first, let's talk about the shocking reality of mortgage interest. The shocking reality of mortgage interest. You finally achieved the goal of becoming a homeowner. You managed to save enough for the down payment, got approved for the mortgage, and finally got the keys. But then reality kicks in. How am I actually going to pay this off? And how much of my monthly payment is truly going towards the house itself versus interest to the bank? The reason mortgages become so expensive is because of one thing many people never fully understand. In the early years of your mortgage, a surprisingly large portion of your payment goes towards interest, not your actual mortgage balance. Banks don't always make this easy to understand, which is why it's so important to learn how mortgages actually work so that you can use strategies to reduce the amount of interest you pay over time. Essentially, every mortgage payment has 2 components, the principal and the interest. The principal is the amount you borrow to buy the home, which you gradually repay over time. The interest is what the bank charges you for borrowing the money. Your interest rate depends on several factors, including the economy, the prime rate, your credit profile, and the lender's pricing. And obviously, the higher the interest rate, the more interest you'll pay over the life of the mortgage. Another major factor is the amortization period, which is simply how long it takes to fully pay off your mortgage. In Canada, the standard amortization is usually 25 years, while in the US, it's often 30 years. Now, while a longer amortization lowers your monthly payment and makes a home feel more affordable, what it actually does is stretch your debt over a much longer period of time, causing you to pay significantly more interest to the bank. And this is where the numbers start becoming shocking. Let's look at what happens with a very normal mortgage in today's market. Let's say the purchase price of the home is $700,000 and you put down $150,000 as a down payment, and you borrow $500,000 on a 30-year mortgage at a 4% rate. Assuming that interest rates stay the same and you only make the required payments without using any of the payoff strategies mentioned today, your total payments over the life of the mortgage will be approximately $945,284. Out of that amount, $550,000 goes towards repaying the mortgage itself, while another staggering $395,284 goes towards interest alone. That means you're paying nearly 72% of the borrowed amount again, just in interest. You could buy another property with the amount paid to the bank in interest alone. Let me know in the comment section below if you found this amount shocking. And honestly, this is exactly why understanding how to reduce mortgage interest is so important, because the longer your mortgage stretches out, the more the bank profits from interest, which also means reducing your mortgage interest is a guaranteed return. Of course, you want to weigh this with other investments out there that may provide higher returns, but it ultimately comes down to what makes sense to you on your financial journey and also what provides you with peace of mind. How to calculate mortgage interest and 8 strategies to pay off your mortgage faster. After my last mortgage video, I received a lot of comments mentioning additional strategies and combinations that could help accelerate mortgage repayment even further. So in today's video, we're going to build on those ideas by comparing multiple strategies side by side to see which one actually makes the biggest impact. As a refresher, let's go over the 3 main strategies again. The first is the annual lump sum payment, which means making an annual lump sum payment directly towards your mortgage principal once per year. Most lenders allow prepayments up to a certain limit. For example, 10 to 20% of the original mortgage balance annually without penalties. This is very important to check check before making the lump sum payment in order to avoid any unnecessary penalties. The key benefit here is that the extra payment goes directly toward the principal, which immediately reduces the amount of interest charged going forward. The second is the monthly principal top-ups, where you add extra money towards the principal portion of the mortgage every single month. This is different from simply increasing your regular mortgage payment because you want to ensure that the extra amount is specifically applied directly against the principal balance. Depending on your lender, you can make payments up to your total monthly payment directly towards your principal without penalty. Make sure to confirm with your lender before making additional top-ups and to double check that they are going towards the principal and not interest. Even relatively small monthly top-ups can make a surprisingly large difference over time, especially if you do it consistently month over month. 3. Accelerated bi-weekly payments. Instead of making one monthly payment, you could split your payment into bi-weekly payments. Because there are 26 bi-weekly periods in a year, you effectively make one extra monthly payment annually without feeling the impact as much from a cash flow perspective. This helps reduce your amortization period and the total interest paid over time. Now we're going to take the extra step and combine these strategies in different ways and compare them against the base case scenario. For each strategy, we're going to compare the interest paid, total interest saved, as well as how many years earlier the mortgage gets paid off. And at the end, we'll rank all 8 strategies from least to most effective so that you can clearly see which strategies save the most interest and which one helps you become mortgage free the fastest. So let's jump into the numbers. Welcome to the tutorial portion of this video where we'll be going through the calculations and the 8 scenarios in detail. Before we get started, let's go over some quick housekeeping. If you do want access to this particular template, make sure to check out the description box down below. And if you want to make edits to it, there are instructions here on how to do it. I do want to go over this because I do get a lot of edit requests. All you have to do is simply go to File, make a copy in order to save it on your Google Drive and make edits, or you could go to Download and do Excel in order to download a hard copy on your desktop and make changes that way. Just wanted to get that out of the way before we get started. This is the updated template from the last time I made this video, and as you can see, we are going to be going over 8 different scenarios. But before we jump into the results, let's quickly go over the assumptions because that really impacts the final numbers. Let's start off with the mortgage amount. So this is the amount that you borrow from the bank. Mind you, this excludes any deposits or any principal payments you made. This is simply the amount that you borrowed from the bank and that you need to repay. That is going to be $550,000 in our case. The annual percentage for the mortgage interest rate is 4%. And so this has come down a little bit since the last time I made this video a year ago. The amortization period is 30 years. So this can range from 25 to 30 years. I've used 30 years in our case. And based on those assumptions, you can see that the calculated fixed monthly payment is $2,626. Now this can be a little bit off compared to what your bank has provided, but it shouldn't be too different, maybe, a few dollars off. But for the purposes of this estimate, we'll be using this amount. And you can see that the cells here are color coded. The cells in green, you need to update for your specific numbers. And once you update the cells in green, there are cells in gray, which means automatic. So it's going to be automatically updated based on the assumptions that you provide. So that is why in this cell, it has calculated the fixed monthly payment based on the assumptions you provided above here. Now, there are going to be 3 numbers that we're going to use in order to come up with our scenario analysis. The first is the lump sum payment. So let's say that you put aside some extra cash and you're deciding what to do with it, whether it's to pay off your mortgage or to go on a vacation or to invest, and you have this extra cash sitting and you're contemplating whether to pay off the mortgage sooner. Let's use that number as $30,000. The second number here is going to be the extra monthly payment. So extra savings that you could come up with every month that you could use towards paying off your mortgage. In our case, it's going to be $300. And the last number is going to be the payment frequency. In our specific case, we've fixed it as bi-weekly payment. So we're going to compare the impact of monthly payments, which is our base case, versus bi-weekly payments, which means paying 26 periods out of the year. And this simply means taking your monthly payments and dividing it by half. So those are going to be our assumptions. Now, there are 8 different scenarios that we're going to come up with. The first is base case. This basically means that if you don't do anything and you just keep on going at the rate you're going, what would be the result there? Scenarios 2 to 4 consider one factor. So scenario 2 is going to be simply lump sum payment putting the $30,000 towards your mortgage. Scenario 2 is making that extra monthly payment, so the $300 here every single month. And scenario 4 is going to be bi-weekly payments, so making 26 payments per year compared to the standard 12-month or monthly payments made in a year. Now, scenarios 5 to 7 considers two factors, and it's just a combination of the factors here above. The first is going to be the lump sum payment plus the extra monthly payment and seeing what that impact is. Scenario 6 is going to be the extra monthly payment that you can make plus the bi-weekly payment frequency. And scenario 7 is going to be the lump sum payment plus the bi-weekly payment frequency. Now, scenario 8 is going to be the combination of all three, which is the lump sum payment plus the bi-weekly payment frequency. So it's going to combine all three. And we can see what the impact is going to be. Let's jump over the base case scenario. And there's going to be a tab for each of the scenarios. So let's move on to scenario 1. You can see all the cells here are being pulled from the summary and they're all in gray, so which means you don't need to do anything to update it. It will automatically update on its own. And you can see that the payment amount stays the same, whereas the interest in the principal changes. So you can see that the interest amount of the total payment of $2,626 is $1,833. So you can see the majority of your monthly payments are going towards interest, and the principal amount, which is paying off your mortgage, the original balance, is only $792. You can see that based on your original balance of $550,000, it only goes down by $792, and this amount goes towards the bank's profits. Now, the good news is as you pay off your mortgage every month, your interest amount goes down because you are paying off the principal little by little. Now you can see in this case, the interest decreases little by little every single month, and then the principal increases little by little every single month. And there's a nifty little graph here that shows that initially the interest is greater than the principal, and then over time at a certain point here that the principal increases and then the interest decreases, and then at the end you completely pay off your mortgage and the home is fully yours. And you can see here how the balance of the mortgage balance is being paid off over time as well. So that's going to be the base case. And so if you don't do anything, the total interest paid over 30 years is going to be $395,284. Now, mind you, that's just interest, and you'll also be paying off the principal. So the total payments that you make over 30 years is actually $945,000, which is that amount plus that amount. So quite shocking. In our base case, there's no interest saved because you haven't done anything different. You pay it off in 30 years. There's no years saved. And so this is considered the worst strategy out of the 8 in our case. Now for scenario 2, for the lump sum payment, the assumption here is that you're going to take that $30,000 and you're going to pay off your mortgage amount, which gets reduced from $550,000 to $520,000. So that amount gets updated here and everything else is automated. And you can see right away that the interest is lower than our base case scenario by $100. So when you compare the graphs, you can see that the point where you pay off the principal sooner is much faster than in our base case. So if you were to compare, let's say that point is the 150-month mark, and here it's a little bit sooner. So you can see that where the principal amount becomes similar to interest amount is around the 117th month mark, which is much sooner than our base case scenario. In this case, the interest paid is $331,000, in which you save $63,770 of interest, and you pay it off in 27 years, which means that you become mortgage-free faster by 3 years. And in this case, the ranking is 6. Now, the scenario 3 is making the extra monthly payment. So in that case, it's going to be the $300 paid every single month. In that case, when you look at scenario 3, that has already all been updated here. You can see that the fixed monthly payment here is $300 higher than our base case over here. And in this case, you can see that the extra $300 is going towards principal. So $1,092 versus $792 in our base case. And so it pays off the balance faster, which means the next month that the interest is slightly lower. It's not a huge difference yet. It's only $1, but you can see that the effects compound month over month. And ultimately, the point where your monthly payments go mostly towards your principal than your interest is sooner. Maybe the 70 or 80 month mark compared to our base case, which is around the 150 month mark. And that little amount compounds over time. And in our summary here, the total interest paid is $316,000, which means that you save save $79,000 in interest, which equates to you paying off your mortgage in 24.7 years, which means you save 5.3 years and you're mortgage-free 5.3 years faster. And the ranking here is the 5th best option. Now, scenario 4 is all about making bi-weekly payments, so paying your mortgage every 2 weeks instead of on a monthly basis, and that simply means taking your monthly payment and dividing it by 2. And so because there are 26 bi-weekly periods in a year, you're going to be making 26 payments. And when you go to scenario 4, in this case, you can see that the total periods have increased to 780 compared to the 360 in our base case, and the interest and the payments are also updated to reflect that. Keep that in mind when looking at the numbers. They're going to be slightly different just because of the payment frequency. In this case, you can see that for the bi-weekly payments, you're making total interest of $333,000, of which interest saved is $62,000, and you get to pay off your mortgage in about 26 years. And so you save 4 years in paying off your mortgage, and the ranking here is 7. Now, moving on into scenarios 5 to 7, this is going to be a combination of the 2 factors. The first factor here is scenario 5, where you make the lump sum payment of $30,000 plus the monthly of $300. There's going to be more details in scenario 5, so feel free to take a look at it. But in our case, we're just going to jump ahead and see what that impact is going to be. In this case, your total interest paid is going to be $269,000, in which you save $126,000. So you're saving over $6,000 in interest alone. You also pay off your mortgage in 22.5 years, which shaves off 7.5 years in paying off your mortgage. And the ranking here is number 2, so it's the second best strategy out of the 8. Scenario 6 is going to be all about making that extra monthly payment of $300 plus making it on a bi-weekly basis. In that case, your interest paid is $271,000, where you save $123,000 in interest, and you pay off your mortgage in only 21.6 years, and you've saved 8.4 years, and the ranking here is number 3. Now, scenario 7 is about making that lump sum payment of $30,000 plus the bi-weekly of 26 periods. In this case, your total interest paid is going to be around $282,700, in which you saved $112,500 in interest. It's going to take you 23.5 years to pay it off, which saves you 6.5 years, and the ranking here is number 4. Now, the ultimate, I think we could all assume, strategy is going to be combining all 3. So let's see what that impact is going to be. And you can see, if you want to look into it in more details, you could look at here. Just by looking at the graph itself, you could see that your monthly payment is going to go towards the principal more than your interest much faster. So that point is much faster compared to, let's say, the base case, where it's going to be much later. So in this case, just by looking at the interest, you could see that it's $800 in the first month compared to $1,833. So you're saving $1,000 in interest in the first month by combining all 3 strategies. So going back to the summary, you can see by combining all 3 strategies, your interest paid is going to be $233,000, where you save $162,000 in interest. It takes you 19.8 years to pay it off, which saves you a decade from paying off your mortgage, and the ranking here is clearly 1. So out of the 8 strategies, you can see that obviously combining all 3 factors is going to be the best outcome, and then it's going to be the lump sum and extra monthly payment, then it's going to be the extra monthly and bi-weekly, and then it's going to be the lump sum and bi-weekly. If you could only do one factor, then consider doing the extra monthly payment, then the lump sum, then the bi-weekly, and then obviously if you don't do anything, that's going to be the worst outcome in our scenario. And now keep in mind that these rankings and these numbers are going to change drastically based on your assumptions. So let's say that your lump sum is $15,000 and your extra monthly stays the same at $300. And in this case, you can see the numbers and the rankings have shifted. Let's change the monthly to $500. You can see that in this case, it's better to do the extra monthly payment versus our original. So you can see the numbers shifting. So it's really important to do a sensitivity analysis and play with the numbers and see, maximum you could put down, the minimum, and consider what you can do at this moment, whether it's just 1 factor, 2 factor, or even better, 3 factors, and compare the different strategies to ultimately determine which one is going to be the best for you in paying off your mortgage faster. And if you want access to this template template, make sure to check out the description box down below. After going through all 8 strategies, what do they all have in common? The goal is simple: reduce your mortgage principal as early and as often as possible, because the sooner you reduce the outstanding balance, the less interest the bank can charge you over time. On the other hand, when your mortgage stretches over decades, you continue paying interest year after year on a large outstanding balance, which is exactly how banks make so much money from mortgages. And what's powerful is that even relatively small extra payments made consistently can save you tens of thousands or even hundreds of thousands of dollars over the life of your mortgage. But beyond the numbers, the real goal isn't just paying off a house. It's about creating freedom from debt, freedom from massive monthly obligations, freedom to invest more, work less, travel more, or simply have peace of mind. And the earlier you reduce your mortgage balance, the faster you get there. If this video gave you more clarity around how mortgages and mortgage interest actually work, let me know by giving this video a thumbs up. And if you want access to the exact template I used in today's video to compare all 8 strategies and calculate your own mortgage payoff timeline, check out the link in the description box down below. Thanks so much for watching today, and I'll see you guys in my next video. Bye!